What does it really mean to be intelligent with money? Not just lucky, not just smart, but wise, thoughtful, long-term, focused. The Intelligent Investor, the legendary book by Benjamin Graham, the man known as the father of value investing and the mentor to Warren Buffett. This book is more than just financial advice. It's a mindset, a philosophy, a guide for how to protect your wealth, grow it steadily, and avoid the dangerous emotional traps of the stock market. Written decades ago, but still just as powerful today, this book will change how you think about investing forever. Because as Graham wants to say, an intelligent investor is not someone who beats the market. It's someone who doesn't get beaten by it. So let's break it down, segment by segment, and understand how you too can become an intelligent investor. Segment 1. The true meaning of intelligent. Let's begin with one of the most misunderstood phrases in investing: intelligent. Most people hear it and think, oh, so this book must be for finance experts, economists, or people with MBAs from Harvard. But that's exactly what Benjamin Graham wants to change. In his world, being intelligent has nothing to do with IQ. It has nothing to do with arithmetic ability, or market expertise, or being able to anticipate where the stock market will go next week. Intelligence, according to Graham, is an attitude. And one idea right here is the foundation of everything else in the book. So, what is an intelligent investor? Graham writes something really strong right at the start. The investor's chief problem, and even his worst enemy, is likely to be himself. Let that sink in. It's not the market. It's not the economy. It's not inflation, interest rates, or conflict. It's you, your feelings, your impatience, your greed, your fear. The clever investor is someone who masters these emotions and makes judgments based on logic, discipline, and patience, not feelings. You don't need to be a genius. You only need to remain calm when others are panicking, and cautious when others are cheering. Because the stock market is a place full of noise. Headlines, excitement, hot stocks, fear-based news. It's designed to mess with your head. And if you follow the mob, if you react emotionally, if you pursue what's trending, you will get burnt. That's why Graham makes it clear. Being intelligent is not about winning the market, it's about not letting the market defeat you. Emotional control, the real superpower. Think about the last time the market fell. Maybe it was 2020 during COVID. Maybe earlier. What happened? People terrified, they sold their stocks. They watched news 24/7. They feared it was the end. But wise investors, those who grasped what Graham taught, maintained quiet. They didn't sell. In fact, many of them bought more. And when the market recovered, guess who came out on top? That's emotional intelligence. That's patience. That's Graham's version of intelligence. Intelligence is about behavior, not brilliance. Graham tells us that genuine success in investing doesn't come from being smarter than others. It comes from being more disciplined. Let me ask you this. Have you ever bought a stock just because it was going up? Or sold one just because it dropped and you panicked? Maybe someone on YouTube shouted, "This is the next big thing," and you rushed in. That's not intelligence, that's impulse. Graham's savvy investor doesn't follow trends. They don't get thrilled when everyone's making money. They don't become terrified when the news claims the sky is falling. They follow their plan. They analyze before they act. They recognize that money is built slowly, not emotionally. Real-life example, a calm investor wins. Let's take an actual example. Imagine two persons during a market meltdown. Person A turns on the TV, sees red arrows everywhere and thinks, "I'm going to lose everything." They sell everything. Person B, an intelligent investor, thinks differently. Okay, the market is down, but my assets are strong. These companies are still making money. Their long-term prospects hasn't changed. Person B holds, maybe even buys more. A year later, the market is back up. Person A has regrets, person B has results. That's the distinction Graham is teaching. That's what intellect looks like. Intelligence is rare, but learnable. Now here's the good news. This level of intelligence isn't something you're born with. You don't need a degree. You don't need insider tips. You don't need to be perfect. You merely need to train your emotions. You need to acknowledge that. You won't always be right. Markets will move up and down. Sometimes, doing nothing is the smartest thing you can do. And once you grasp that, you'll be ahead of 90% of investors out there. Because most individuals are not intelligent investors. They're not ignorant, they're simply emotional. They're looking for shortcuts, for excitement, for rapid results. Graham cautions us that this thinking leads to loss. But if you stay grounded, you'll win in the long run. Final thought for this segment. Let's finish this session with one of Benjamin Graham's most essential lessons. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. In other words, you don't need to chase perfection. You just need to avoid large blunders. You don't have to outperform everyone. You just have to restrain yourself. That, according to Benjamin Graham, is actual investment intelligence. And that's the basis we'll build on as we explore the rest of the book. Segment 2. Investment versus speculation. Know the difference, save your future. Now that we understand what it genuinely means to be educated, let's look at the first significant decision any investor must make. And that is, are you investing or are you speculating? This might sound like a technical difference, but according to Benjamin Graham, it's one of the most harmful misunderstandings in the whole financial world. Why? Because people lose money not because of bad luck. Not even because of lousy timing. They lose money because they think they're investing, while in reality, they're speculating. So what's the difference? Let's break it down in the simplest possible way. An investor seeks for value. They examine a corporation. They ask, is this business strong? Is it profitable? Does it have a future? They want to possess something worthwhile and keep it for a long time. A speculator, on the other hand, doesn't truly care about the business. They care about the pricing. They buy since the price is going higher. They sell because it's going down. They're not thinking 5 years ahead, they're thinking 5 minutes ahead. Graham puts it like this. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not satisfying these parameters are speculative. So if you're not doing research, if you're only buying based on buzz, advice, or gut feeling, you're not investing, you're gambling. Why speculation is dangerous. Graham doesn't suggest conjecture is wicked or should never be done, but he thinks the danger comes when you don't realize you're doing it. If you walk into a casino and you know it's a game of chance, fine, that's your option. But if someone tells you, hey, this is a guaranteed win, and you believe them, you're in trouble. That's exactly how the modern stock market operates. Social media, YouTube, influencers, hot stocks, meme stocks, crypto coins. All of these can beguile you into feeling you're making smart choices, when in reality you're just chasing trends. And Graham warns, speculating while thinking you're investing is the easiest way to lose both money and confidence. Speculation is not new, but it's louder now. Here's the crazy bit. This book was written almost 70 years ago, long before TikTok finance and Reddit stock advice. But Graham already spotted the pattern. Markets have always had booms and busts. People have always pursued rapid profits. The names change. The tools evolve, but the behavior? It's the same. That's why the intelligent investor still matters today. Because human emotions haven't changed. Fear, greed, overconfidence, impulse. These are timeless. What does speculation look like? Here are a few red flags that tell you you're speculating. You're buying only because the price got increased fast. You're following someone else's hot tip without researching it yourself. You're trying to time the market, guessing when to jump in or out. You're putting in money looking for a quick 10x. And most dangerously, you don't have a plan. The clever investor always has a plan. They know why they're buying things. They've thought about the hazards. They're okay waiting for years to see results. Speculators? They want results now. The speculation trap. Real story. Let me tell you a simple story. A young investor watched everyone around him making money in tech stocks. Every day, someone on Twitter was talking about the next big thing. So, he jumped in. No research, just FOMO. The fear of missing out. And initially, he made a little money, felt like a genius. So he invested more. Took bigger chances. Then the crash came. And just like that, everything was gone. Why? Because he wasn't investing. He was speculating. And he didn't even know it. Benjamin Graham saw this coming decades ago and warned us. So, is speculation always bad? No. Graham is not suggesting you should never speculate, but if you choose to do it with full knowledge. He actually provides a sensible rule. If you speculate, keep it separate. Never let speculation reach more than 10% of your portfolio. It's like junk food. A little is fine. But if it becomes your complete diet, it will harm your health. In the same way, if your entire investment technique is predicated on excitement and optimism, you're building your future on sand. How the intelligent investor acts. Here's the clever way to approach the market. Think long-term. Study the business behind the stock. Focus on actual value, not just price swings. Be okay with being boring. Great investing is not exciting. Avoid reacting to short-term market noise. Graham wants to teach us investing is about growing money responsibly over time, not gambling for rapid returns. It's not about beating the market every day. It's about establishing something you can rely on for decades. Final thought for this segment. Let's close this segment with a question only you can answer. Am I investing or am I speculating? Be honest. Because that one response could decide whether you grow money slowly and surely or burn out chasing shortcuts. Benjamin Graham provides us the clarity to make that choice properly. So from now on, choose to be an investor, not a gambler. Segment 3. The defensive versus enterprising investor. Who are you really? So now you know what it actually means to be wise when it comes to investing, and you understand the significant difference between investing and speculating. Now follows the next critical phase in Benjamin Graham's philosophy. Who are you really? No, not your work, not your age, nor your portfolio size. But deep down, what kind of investor are you? According to Graham, every clever investor fits into one of two major categories: the defensive investor, the enterprising investor. And deciding between the two might be the most significant decision you make in your investment path, because each type takes an entirely different technique, mindset, and level of dedication. 1. The defensive investor. Safety first. Let's start with the defensive investor, also called the passive investor. This person doesn't want to spend hours analyzing financial statements. They don't want to examine charts or decode business earnings. They simply want to increase their money over time, prevent catastrophic losses, and preserve their future. And Graham appreciates that. In fact, he argues most individuals, yes, most, should be defensive investors. And why? Because it's hard to defeat the market. It takes time, focus, and emotional resilience. And most individuals have other priorities, their job, their family, their life. So instead of attempting to be an expert, the defensive investor constructs a portfolio that is safe, simple, stable. This involves diversifying carefully, keeping to strong firms or index funds, and avoiding speculation outright. It might sound boring, but remember, dull is beautiful in investment. What does a defensive portfolio look like? Graham gives a few timeless tips. Diversify over at least 10 to 30 high-quality stocks. Don't go all in on one firm. Spread your risk. Look for huge, financially strong companies and think of businesses that have been operating for decades and know how to survive rough times. Avoid companies with heavy debt. If a business is drowning in loans, it's fragile. Check for stable profits over the last 10 years. You want steadiness, not drama. Focus on fair price to earnings, PE ratios. Don't chase high-flying stocks, look for fair value. Prefer companies that offer consistent dividends. This shows they're healthy and devoted to rewarding shareholders. The idea here isn't to get rich soon, it's to get rich securely. And that's what makes a defensive investor intelligent. 2. The enterprising investor. Effort for extra reward. Now let's talk about the enterprising investor, also known as the active investor. This person is willing to put in the time. They enjoy research. They seek to look deep into a company's data, management, and long-term prospects. They're not just investing money, they're investing energy. But Graham is quite clear. This is not for everyone. The enterprising path is full of traps. You can get emotional. You can get overconfident. You can get lazy. So if you're going to be enterprising, you need discipline and a method. What does an enterprising strategy look like? Here's what Graham suggests. Look for undervalued equities, firms trading below their true worth. Study special situations, mergers, restructures, or temporary setbacks that can generate wealth. Examine financial statements deeply. This entails reading yearly reports, balance sheets, income statements. Be patient and selective. Don't just buy something because it feels right. Buy when the facts justify it. And most importantly, always safeguard your downside. Even adventurous investors require a margin of safety, something we'll cover in detail in the following segment. Can you be a mix of both? This is a question many ask. Can I be partially protective and partly enterprising? Graham says, not really. You need to choose, because blending the two typically leads to blunders. You take on dangers without knowing them. You make moves without full commitment. You think you're playing it safe, but you're not. So, the superior strategy: be honest with yourself. And if you're not interested about finance, if you don't want to study businesses, adopt the defensive approach. It's smart. It works. And it's absolutely respectable. But if you're sincere, consistent, and willing to work for it, then follow the enterprising way. Just know that it's not a shortcut. It's a job. Warren Buffett's take. Here's something interesting. Warren Buffett, one of Graham's most famous disciples, labels himself an innovative investor, but only after understanding the basics. And even Buffett argues most consumers would be better off investing in low-cost index funds, a defensive strategy. So don't feel compelled to be the next Buffett. Just aspire to be a smart version of yourself. Final thought for this segment. Let's finish this with a great truth from Benjamin Graham. The investor's choice between the defensive and enterprising roles is largely a matter of temperament. It's not about intelligence, it's not about knowledge, it's about knowing yourself. The defensive investor safeguards wealth. The entrepreneurial investor strives to expand it faster, with higher effort and risk. Both are valid, both are intelligent, but only if you stay committed to your choice. So, who are you? Not who you aspire to be, but who you truly are today, honestly. Because once you decide that, the remainder of your investing path gets a whole lot clearer. Segment 4. Margin of safety. Your armor in the world of investing. All right, now that you know who you are as an investor, whether you're defensive or enterprising, it's time to study what Benjamin Graham calls the single most important notion in investing: the margin of safety. This idea is simple, but completely life-changing. In fact, Warren Buffett says a margin of safety is the cornerstone of investment success. So, what is it? Why does it matter? And how might it protect you from significant losses? Let's break it down. What is a margin of safety? Imagine you're building a bridge. It's meant to handle trucks that weigh 10 tons. Would you build it to exactly 10 tons? No. You'd probably construct it to accommodate 15 or even 20 tons, just in case. That increased weight capacity, that's your margin of safety. In investment, it works the same way. It implies you buy a stock or an asset for less than it's actually worth. So even if something goes wrong, you're still covered. Example, buying at a discount. Let's say you analyze a company and find it's genuinely worth $100 per share, but the stock is currently trading at $65. If your research is solid and nothing major is wrong with the firm, that price difference, that $35 cushion, is your margin of safety. It provides you space for error. It accounts for uncertainty. It shields you from market surprises. Because let's be real, no one gets it 100% correctly. Even the finest investors make erroneous assumptions, miss facts, or face unanticipated circumstances. The margin of safety is like an airbag. You hope you never use it, but it could save you should things crash. Why? Graham emphasizes it so much. Graham says, the function of the margin of safety is in essence that of rendering unnecessary and accurate estimate of the future. In simple words, you don't need to forecast the future precisely if you leave enough room for mistakes. He realizes that the world of business is full of unknowns. CEOs change, recessions hit, wars start, pandemics shut everything down. But if you only invest when there's a sufficient margin between price and value, you can ride out the storm. Emotional protection too. And here's something people don't talk about enough. A margin of safety also safeguards your emotions. When you acquire something too near to its fair value, every tiny decrease in the stock price makes you concerned. But if you get in cheap, you feel confident. You know you have a cushion. You're not stressed if the market declines a little. You're not tempted to sell out of fear. And that calm mindset, that emotional control, is crucial in investing. Remember what Graham said earlier? The investor's worst enemy is himself. The margin of safety helps keep that enemy in check. Where most people go wrong, let's talk about what occurs when investors ignore this idea. You've probably seen it, or maybe even lived it. A stock is hyped. Everyone says, it's going to the moon. You buy in at the top, with zero margin of safety. You're paying full price, or perhaps overpaying. Then, bang. The corporation misses earnings. The market dips. Bad news hits. And your investment decreases 40% overnight. You panic, you sell, you lose, all because you bought without a cushion. Benjamin Graham cautions us again and over again. Even the intelligent investor is likely to need considerable willpower to keep from following the crowd. The margin of safety helps you resist the mob, because it puts your decision-making back to logic, not emotion. It's not just for stocks. And here's something powerful. The margin of safety is not simply for picking stocks. It applies to everything in your financial life. Buying a house, don't stretch your budget to the limit, leave a buffer. Starting a business, have cash saved, leave a margin. Making career moves, don't jump without a backup plan, leave a cushion. This principle is a way of living, not simply investing. It's about being prepared, not panicked. It's about being realistic, not reckless. It's about being sensible, not wild. How to apply it in real life. So, how can you put a margin of safety into your investments? Here are a few practical ways. Buy below intrinsic value. Strive for at least a 20 to 30% markdown. Invest in companies with excellent balance sheets, little debt, healthy cash flow. Avoid equities priced for perfection. If the slightest unfavorable news will smash the stock, it's too risky. Diversify. Spread your risk so no single loss can damage you. Be conservative in your assumptions. Better to underestimate than to exaggerate. This is the reverse of hype culture. It's the reverse of YOLO investing. But that's the goal. Because the intelligent investor doesn't gamble, they build. They don't guess. They prepare. They don't chase. They wait. Warren Buffett's application. You want to know how real this notion is? Warren Buffett, Graham's most renowned student, has said this notion is the single most significant lesson he learned from Graham. He seeks for companies selling at an obvious discount to their genuine worth. And he never buys just because a stock is popular or intriguing, and he buys when it's discounted, underestimated, and beneath the radar. That's margin of safety in action, and it's helped him establish one of the finest investing records in history. Final thought for this segment. Let's finish with this simple but unforgettable truth from Benjamin Graham. You don't need to be right all the time. Just make sure that when you're wrong, you don't lose everything. That's the power of the margin of safety. It's not about perfection. It's about protection. It's not about magic. It's about math and maturity. So from now on, before you invest in anything, pause and ask yourself, is there enough margin? Or am I simply hoping for the best? Because hope is not a strategy. But margin is smart. Segment 5. Mr. Market. The emotional business partner you must learn to ignore. Imagine you had a business partner. Let's call him Mr. Market. Now here's the thing about Mr. Market. He's not ordinary. He's moody, irrational, emotionally unstable. One day he's joyful. He wants to acquire your shares at crazily high prices. The next day he's depressed, and he offers to sell you his shares for dirt cheap. This is the metaphor that Benjamin Graham devised to explain how the stock market behaves. It's simple, it's brilliant, and once you comprehend it, you'll never look at the market the same way again. Who is Mr. Market? Mr. Market depicts the entire stock market every single day, sometimes numerous times a day. He comes up at your door and says, "Hey, want to sell your shares or buy more? Here's today's price." Now, you don't have to answer. You may ignore him. You can close the door, but he'll be back tomorrow with a new price and a new mood. This is how pricing in the stock market work. They're not necessarily based on logic. They're not always dependent on company performance. They're based on what people feel, their enthusiasm, fear, greed, or panic. Mr. Market is emotional, and he wants you to feel emotional too. Why? This metaphor is genius. Let's say you own a small bakery with a pal. Every morning your pal walks in and says, "Hey, I think this bakery is worth $1,000. Want you sell me your half?" Next day he says, "No, wait, it's only worth $700. I'll sell you my steak cheap." Then the next day, "It's worth $3,000. Let's go big." Now, imagine making business decisions based on his emotional swings. That's how people behave with stocks. They treat market pricing as facts, when really, they're simply opinions. Graham built Mr. Market to teach us. The market is there to serve you, not to instruct you. In other words, you don't have to follow his mood. You use him, but don't let him use you. The mistake most people make. Most investors react to the market's sentiment. When Mr. Market is thrilled, people buy, even if prices are excessively high. When Mr. Market is depressed, they sell, even if the firm is still solid. And this is exactly how individuals lose money, because they follow emotions, not reasoning. They treat market pricing as truth instead of transient sentiments. Benjamin Graham urges us to flip that thinking. He teaches, the intelligent investor is a realist who sells to optimists and buys from pessimists. So when Mr. Market is panicked, it might be your chance to buy. When he's overconfident, it can be your cue to hold or sell. but you can't do that if you get caught up in his drama. Real-life story, the 2008 crash. Let's go back to 2008. The market crashed, banks failed, people lost jobs, panic everywhere. Mr. Market showed up at everyone's door shouting, "It's over! The economy's shattered! Sell everything now or lose it all!" And millions of people listened. They sold their investments at rock-bottom prices. They locked in their losses because they trusted Mr. Market's fear. But intelligent investors, they remembered Graham's counsel. They understood the enterprises they owned were solid. They regarded Mr. Market's fright as an opportunity. So they stayed calm. Some even bought extra. And guess what? A few years later, the market recovered, and those that kept sensible received tremendous dividends. Mr. Market is your servant, not your guide. Graham argues you should respect Mr. Market like a servant, not a master. He's there to offer you a price. But you don't have to accept it. You only act when the deal is right. Think of it like shopping. If something you value is on sale and you've done your homework, purchase it. If it's pricey, even if everyone is hurrying to buy it, go away. The market is basically a shop window. The price tags are not orders, they're offers. And your duty isn't to know what the object is actually worth, not what the pricing says today. Don't fall in love with the price. This is vital. Most individuals focus exclusively on the price of a stock. It went up 10% today. It's down 5%. Should I panic? This stock is hot. That one is crashing! But Graham argues, that's just Mr. Market talking. The clever investor focuses on value, not price. You buy a stock like you're buying a business. If it's a good business, steady, growing, profitable, you stay with it. You don't let the daily price influence your confidence in its value. Graham's genius is in reminding us, price is what you pay, value is what you get. Warren Buffett's love for Mr. Market. Warren Buffett typically credits this metaphor as one of the most important teachings he ever learned. He says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Why? Because Buffett doesn't care what Mr. Market says today. He solely worries about the business behind the stock and what it will be worth over time. So next time the market is screaming, take a breath. Ask, is this a business I believe in or just a price I'm chasing? That's how savvy investors win. And stay sane. Final thought for this segment. So here's your takeaway. Mr. Market will never stop talking. He'll always be emotional. He'll offer you pricing every single day. Some too high, others too low. But your job is not to respond. Your job is to think. Don't follow him. Use him. Let him panic. Let him celebrate. You stay grounded. Because in the end, the savvy investor knows. Mr. Market is not your teacher. He's simply noise. And if you stop listening to that noise, you finally start creating actual riches. Segment 6. The power of long-term thinking. Where true wealth is built. If there's one truth that differentiates the affluent investor from the average investor, it's this. Long-term thinking. It's not flashy, it's not trending, and it won't get you rich in 3 weeks, but it's the very thing that develops generational wealth and protects it when storms hit. And in The Intelligent Investor, Benjamin Graham makes it perfectly clear. The investor's portfolio should be based not on speculation, but on a sound, long-term plan. Let's unpack this, because once you embrace this perspective, the way you see money, markets, and your future will alter forever. Why long-term thinking is rare and powerful. Let's be honest. We live in a now-obsessed world. Instant pleasure is everywhere. One-click shopping. 15-second videos. Crypto pumps. 10x your money by Friday headlines. So it's no wonder that when people invest, they demand rapid results. But Graham tells us, this thinking is the enemy of true investing. He says, the stock market is a device for transferring money from the impatient to the patient. Did you catch that? The patient, not the genius, ends up affluent because markets go up and down. That's normal. But over the long run, if you've chosen your assets well, been disciplined, and avoided the noise, the odds are enormously in your favor. What does long-term really mean? Long-term doesn't imply 3 months. It doesn't mean 1 year. Graham, and later Buffett, define long-term as 5, 10, 20 years or more. They're not looking for next quarter's profits, they're thinking in decades. They ask, will this company still be strong in 10 years? Will this investment grow with the economy? Can I sleep peacefully, knowing this will ride out a crash? And that's what you should be asking too. Because true wealth doesn't come from timing the market. It comes from time in the market. Real example, the power of staying in. Let's take an actual story. Imagine you put $10,000 in an index fund like the S&P 500 in 1990. Now, assume you never touched it. You didn't sell during recessions. You didn't try to time the market. You just left things alone. By 2020, the $10,000 would be worth roughly $180,000. Maybe more. But what if you missed just the 10 finest days in the market throughout those 30 years? Your return would be decreased in half, and majority of those top days happened soon after market crashes, the exact period when people panic and sell. That's the power of staying in. That's the prize for long-term thinking. Why most people fail at this? Now you might say, okay, that sounds great, but why don't more people do it? Because it's hard. Long-term investing requires patience when others are hurrying, discipline when others are panicking, conviction when your portfolio is down. It means holding on during market crashes when everyone in the press is screaming you to run. It means sitting idle while your buddies talk about their hot picks that doubled in a week. It means saying no to short-term dopamine and choosing yes to long-term peace of mind. This is emotional maturity, and Graham argues it's the fundamental secret of the wise investor. Think like an owner, not a trader. Here's an attitude shift that can improve your life. Don't think like a stock trader. Think like a business owner. When you acquire a share of a corporation, you're not buying a lottery ticket. You're buying ownership. Would you buy a pizza restaurant and sell it 3 days later only because someone offered you 5% less than you paid? Of course not. You'd analyze its future, its customer base, its costs and earnings. You'd hold through slow months because you believe in the business. That's how Graham wants you to think about every stock you own. If you believe in the worth of the firm, short-term swings shouldn't unsettle you. You don't worry when the price lowers. You stay cool because you know what you possess. Long-term thinking equals freedom. There's another great perk of long-term investing, and it provides you tranquility. You're not checking your portfolio every 10 minutes. You're not glued to the news. You're not emotionally swinging with every market move. Instead, you're focused on the larger picture. And that provides you freedom, mental, emotional, and even spiritual. Graham calls this investing with serenity. When your assets are structured for the long haul, you sleep better. You live better. You make decisions from strength, not fear. Long-term doesn't mean set it and forget it. One brief clarification. Long-term investment doesn't mean you never analyze your portfolio. It means you don't overreact, and you still do your research, you check in, you readjust when needed. But you don't jump ship every time there's turbulence. You tune out the noise and stay committed to your strategy. Graham's message is this: to be an intelligent investor, you must refuse to let temporary declines influence your decisions. This thinking protects you. It keeps you grounded. And over time, it produces genuine, permanent riches. Final thought for this segment. Let's finish with one of Graham's profound lessons. The real money in investing will be made, not out of buying and selling, but out of owning and holding securities. So take a breath, zoom out. Don't worry about what the market will do next week. Start thinking about where you want to be in 20 years. Then construct your portfolio to get you there. Because the one who wins in investing isn't the one who moves fastest. It's the one who stays steadfast. Be that person. Segment 7, Understanding Risk and Why Most People Get It Wrong. Let's talk about something that worries most individuals in investing: risk. The term alone is enough to make people hesitate. And for good reason. Nobody wants to lose money, nobody likes to make a mistake, nobody wants remorse. But here's the truth: most folks don't really understand what danger actually is. And that misunderstanding, according to Benjamin Graham, is the reason why people make incorrect decisions, sell at the wrong time, and panic when they should keep calm. So let's clear it up. Let's discuss about what risk truly means, and how the wise investor treats it differently. What people think risk is. When you ask someone, "What's the risk of investing?" they'll say something like, "The price might go down. I might lose money. The market is too volatile." And yes, price swings do happen. Markets go up and down. But Graham says, volatility is not the same thing as risk. Just because something declines in price today doesn't mean it was a bad investment. Just because something is steady doesn't mean it's safe. He challenges us to delve deeper. Because in real life, the true danger isn't what the stock performs. It's what you do when the stock does anything. Real risk equals permanent loss. Graham describes risk as this: the possibility of a permanent loss of capital. That's it. If your investment suddenly declines, but rebounds, grows, and pays off, that's not danger. That's volatility. But if you invest in something without understanding it, without a margin of safety, without a long-term plan, or based on emotion and hype, then you're opening yourself to actual risk, where your money is gone and not coming back. And this kind of loss is nearly always connected to one thing: your actions. It's not the investment. It's the investor. Graham says something really powerful. The investor's worst enemy is likely to be himself. In other words, you are the risk. If you don't control your emotions, your expectations, and your discipline. Because the market will always fluctuate, prices will always fluctuate, and there will always be crashes, corrections, and scary headlines. But if your instinct is to sell in fear, purchase in greed, or panic when others panic, then no investment is secure for you. The intelligent investor understands. Risk isn't about the stock. Risk is about the investor's thinking. Real-world example: the 2010-20 market crash. Let's go back to March 2020. The world shut down. COVID spread globally. Markets plummeted. Nearly 30% in weeks. People were afraid. They sold everything. But the clever investor, using Graham's principles, asked, are these companies suddenly worthless? Has their long-term future changed? Or is this just fear? They held. Some bought more. Fast forward a year. Markets not only rebounded but achieved record highs. Those who ran from risk actually took the biggest risk of all and lost. Those who understood risk stayed strong and won. Diversification, your risk shield. Graham gives us another technique to handle real risk: diversification. This simply means don't put all your money in one basket. Why? Because any single business, industry, or country can encounter issues. But if you distribute your money across different sectors, different corporations, even diverse asset classes, stocks, bonds, real estate, then even if one area suffers, the others balance it out. This minimizes your probability of a permanent loss. That's not just smart, that's savvy investing. Risk-reward unless you're wise. A lot of people say more risk, more reward. But Graham warns that's only true if the risk is calculated. Blind risk, going into something only because it might go up rapidly, is gambling. But informed risk, investing in something undervalued with excellent fundamentals and a margin of safety, that's strategy. The intelligent investor doesn't avoid all risk. They manage it. They respect it. And most importantly, they prepare for it. Your risk tolerance. Know thyself. Another key lesson: know your personal risk tolerance. Graham never says there's one size fits all. Some people can withstand watching their investments decline 20% without worry. Others can't sleep if it dips 5%, and that's okay. But you need to be honest with yourself. Don't construct a portfolio based on what others are doing. Build it depending on what you can emotionally bear. Because the ideal financial strategy is the one you'll actually stick to, even during terrible times. Final thought. Risk is not the enemy. Fear is. Let's close this segment with a remark that flips your whole mindset. In the short run, the market is a voting machine. In the long run, it is a weighing machine. In the short term, equities fluctuate depending on popularity, excitement, news, emotions. But in the long run, they indicate genuine worth, earnings, growth, strength. So don't let short-term moves worry you. Risk is part of life, but it doesn't have to wreck your future. Benjamin Graham wants you to know, if you understand, what you're buying. If you have a plan, if you diversify, if you think long-term, then you're not risking your future, you're building it. Segment 8. The concept of intrinsic value. Know what you're really buying. All right, thus far we've talked about long-term thinking. We've discussed what actual risk means. And we've met Mr. Market, the emotional partner you must learn to ignore. Now it's time to ask a key question. How can you tell if something is genuinely worth buying? That inquiry takes us to one of Benjamin Graham's most compelling ideas. Intrinsic value. If you don't comprehend this, you're not actually investing. You're just guessing. Because price informs you what the market thinks something is worth right now. But intrinsic value informs you what something is genuinely worth based on real facts, real performance, and real potential. Let's break this down. What is intrinsic value? Graham defines intrinsic value as the value which is justified by the facts, earnings, assets, dividends, and definite prospects. In simple words, it's what a firm is genuinely worth, regardless of what the stock market says today. Think of it like this. You stroll into a store and find a jacket on sale for $60. But you know, based on the quality, brand, and stitching, that it's actually worth $100. That difference, that knowledge, that insight, that's your understanding of inherent value. And in investing, comprehending that difference is what separates the intelligent from the emotional. Price versus value. Why this matters. Benjamin Graham repeats this throughout the book. Price is what you pay. Value is what you get. Most investors focus just on the price. They look at stock charts, ticker movements, and daily highs and lows. But clever investors focus on value. They ask, what does this business actually produce? How much money is it making? What's its long-term potential? How much debt does it carry? How sustainable is its advantage? Because if the price is significantly below the value, that's called an opportunity. If the price is significantly above the value, that's considered a trap. How to estimate intrinsic value. Now here's the honest truth. Intrinsic value is not an exact science, and it's not a single flawless number. But you may estimate it using real-world data. And Graham provides us some guidelines. Look at average earnings over the past 7 to 10 years, not just this year. Check the company's book value to its net assets. Study dividend history. Is the company returning value to shareholders? Consider future growth, but be prudent. And most crucial, compare that value to the current pricing. If the market is offering you a price that's far below the value you've determined, that's your margin of safety in action. It's like buying $1 for 60 cents. Intrinsic value isn't just numbers, it's common sense. You don't have to be a math expert. Even Benjamin Graham said that you do not need a business degree to understand value. You need patience and discipline. Ask yourself, would I want to own this entire business even if I couldn't sell it tomorrow? Would I be comfortable collecting revenue from it over the next 10 years? Is the business model straightforward, understandable, and necessary in the world? Because if the business makes sense, and the pricing is good, then the investment can be intelligent. Emotional detachment is key. Here's the trap most people fall into. They conflate an increasing price with worth. They observe a stock moving up and think, this must be a great company. But Graham argues that's risky thinking. Sometimes, prices move higher due to hype, not strength. Sometimes, corporations are overvalued, and the slide is just waiting to come. The clever investor looks through the noise. They keep emotionally disconnected. They evaluate based on facts, not sentiments. And that's why understanding intrinsic value is such a great instrument. It gives you confidence while others are bewildered. Warren Buffett and intrinsic value. Let's take this even further. Warren Buffett, Benjamin Graham's most famous student, says, "Intrinsic value is the number one thing I think about before making an investment." He doesn't care what the price did yesterday. He doesn't care what analysts are saying. He doesn't care what's hot on CNBC or Reddit. He cares about this. Is this business selling for less than it's truly worth? And that's why he's been able to create wealth slowly, safely, and sensibly for over 60 years. Buffett even deems Graham's book the best financial book ever published. That's how deeply this thought affected his life. Applying this in real life. So how can you use this? Here's a basic method. Pick a business you understand, look at its last 10 years of earnings. Are they stable? Read a few yearly reports. Are they managing debt well? Check the dividend history. Are they compensating shareholders? Compare the price today with the projected value. If the price is 20 to 30% below that value, assuming nothing is fundamentally wrong with the company, you may have found a sensible investment. Final thought for this segment. Let's finish with a great reminder from Benjamin Graham. The investor who buys securities at a bargain in relation to their intrinsic value may be confident of doing well in the long run. This is not about timing the market. This is not about being flashy or speedy. This is about being thoughtful, patient, and disciplined. So from now on, before you invest in anything, don't ask, is it going up? Ask, what is this truly worth? Because that question could rescue your future and make your riches something that lasts, not something that fades. Segment 9. Earnings, dividends, and the real drivers of value. Let's imagine you're looking at two companies. One is all over social media, hot, trending, volatile. The other one? Quiet, consistent, not terribly showy, but every year it makes genuine profits and provides dependable dividends. Now here's the question. Which one do you want to bet your future on? According to Benjamin Graham, the answer is simple. The one with real earnings, real cash flow, and a history of sharing those earnings with you, the investor. This is the heart of sensible investing, focused not on what's popular but on what's profitable and proven. Let's delve deep into the two most significant markers of true value, earnings and dividends. Why earnings matter more than price. Price goes up and down. But earnings tell you what the company is actually doing, how much profit it's making. Graham explains, in the long run, the market is a weighing machine. It weighs the value of a company based on its earnings power. This means, over time, the stock market rewards actual businesses that make sustained earnings. If a corporation grows its earnings year after year, the stock price finally reflects that. But if a company doesn't earn or fakes growth, it's only a matter of time before the reality shows up. So, as a savvy investor, your role is to ask, is this company continuously profitable? Is its earnings increase sustainable, or just a short-term trend? Are profits soaring because of strong business decisions, or dangerous debt and hype? These questions safeguard you from hype-driven pitfalls. Don't get fooled by one-year numbers. Now here's something Benjamin Graham warns about strongly. Never rely on a single year's earnings to value a company. Why? Because any firm might have a terrific year or a horrible one. Maybe there was a one-time event or a rapid market boom. Or maybe the corporation slashed expenditures or sold off assets to appear more lucrative. Graham proposes looking at the average earnings over the past 7 to 10 years. This offers you a true view of how the company operates across good times and bad. Remember, as an informed investor, you're not buying a story, you're buying a business. What about dividends? Let's proceed to the second main driver of value: dividends. A dividend is the company's way of saying, hey, investor, here's a portion of the profit. Thank you for owning our stock. It's actual money in your hands, not just paper gains. Graham loves firms that regularly pay dividends year after year because that shows they're producing enough profit to reward shareholders. They're bullish about their long-term prospects. They're not depending exclusively on stock price hype. Now, not every great firm pays a dividend, and that's okay. Some reinvest earnings toward growth, which can also be sensible. But Graham warns, be skeptical of companies that earn billions and return nothing to the owners. Because at some time, profits should trickle back to you. Otherwise, what are you actually investing in? Dividends help you stay calm. Here's another perk folks often overlook. Dividends keep you calm in adverse markets. Let's imagine the stock price drops 15%. The market's panicked. But if that company still provides you a consistent dividend every quarter, that's a signal. The business is still healthy. It gives you courage to hold, not panic. It helps you stay invested, which is crucial to long-term success. Benjamin Graham likes stability and consistency, and dividends are one of the strongest evidence of both. What about growth stocks with no dividends? Great question. Some companies, notably IT, don't pay dividends. They reinvest everything into new products, expansion, innovation. Graham doesn't say that's wrong, but he does say, be cautious. Because currently, the only profit you get depends on how much other investors feel the company will expand in the future. If that faith evaporates, the stock drops and you're left with nothing. So, if you invest in non-dividend equities, Graham says, be considerably more diligent about analyzing their earnings. Make sure growth is real, not imagined. Use a margin of safety. Buy at a discount. Don't put your hope on future price alone. In other words, believe progress, but verify. Always. The connection between earnings, dividends, and intrinsic value. Let's tie this to what we covered in the prior session: intrinsic worth. Remember, intrinsic value is founded on facts, not hype. And the two most significant facts? Earnings. How much a firm truly makes dividends. How much it shares with you. If a corporation grows earnings regularly and shares profits intelligently, its intrinsic value improves over time. And if you bought it below that value and held patiently, you're on the road to true prosperity. Final thought for this segment. Let's conclude up with one of Graham's most empowering truths. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Earnings and dividends are the foundation of that return. So don't chase trends. Don't follow price alone. Don't gamble on hype. Instead, seek for businesses that earn, businesses that reward you. Businesses that are built to last. Because in the end, genuine riches comes not from what's loud, but from what's lasting. Segment 10. Market fluctuations. How to survive the ups and downs. If you've spent any time in the world of investing, you already know one thing is certain. The market never goes in a straight line. It goes up. It goes down. It's unpredictable. Sometimes it feels like a roller coaster, thrilling and terrifying at the same time. But Benjamin Graham says, "Market fluctuations are your friend, not your enemy." Sounds ridiculous, right? Most individuals think of market ups and downs as something to fear, a threat to their hard-earned money. But Graham teaches us to view things differently. Why markets fluctuate? First, let's examine why the market moves. Prices change because of new facts regarding corporations, changes in the economy, political events, global crises, and most importantly, human emotions. Fear, greed, optimism, and fear force prices to move dramatically, frequently far beyond what the actual business is worth. The market doesn't operate like a calculator. It functions more like a voting machine. Individuals vote daily with their money, influenced by their feelings. The investor's reaction matters most. Here's the real lesson Graham wants us to learn. It's not the market's ups and downs that define your success. It's how you react to those ups and downs. Most investors make the mistake of buying when prices are high because everyone else is excited, and selling while prices are low because everyone else is terrified. That's exactly the opposite of what you should do. The intelligent investor's approach to fluctuations. Graham's advice: be fearful when others are greedy, and greedy when others are fearful. When the market is skyrocketing and everyone is pouring in, that's a signal to be careful. When the market falls and everyone is running for the exits, that's frequently your opportunity to buy deals. It needs guts, discipline, and a consistent mindset, using market fluctuations to your advantage. Think about Mr. Market, whom we met before. Remember how he shows up every day with a fresh mood and price? Your duty as a savvy investor is to leverage these mood fluctuations to buy low and sell high. Or better yet, just buy low and hold. If the price slips below what you believe is the business's genuine value, that's when you act. If prices are inflated beyond fundamental value, it's time to be careful. Emotional discipline is your biggest tool. It's easier said than done. When prices plummet 20%, 30% or more, it's easy to panic. But Graham shows us that. The investor who has the courage and discipline to hold steady will be rewarded over time. That involves avoiding the desire to sell in panic. That involves having a plan before the storm hits. Real-life lesson: the 2000 dot-com crash. Look at the 2000 dot-com bubble. Prices of online companies surged, many without revenues or defined business plans. When the bubble broke, markets fell severely. Many investors sold in panic, locking up enormous losses. But savvy investors who grasped underlying value and held solid enterprises persevered, and finally benefited. Avoiding market timing. Graham warns, trying to time the market is a losing game. No one can forecast when the market will rise or fall. Trying to jump in and out based on short-term fluctuations frequently leads to missing the greatest days and large losses. The ideal method is to establish a robust portfolio, stay diversified, and hold through the swings. Tools to survive market fluctuations. Margin of safety. Buy with a buffer below intrinsic value, so even if the market dips, your investment remains sound. Diversification. Spread your investments. Don't put all eggs in one basket. Rebalancing. Periodically evaluate your portfolio and adjust to maintain your risk level. Patience. Understand that money rises slowly and gradually. Final thought for this segment: market ups and downs are inevitable, but they don't have to dominate your emotions or your financial future. Benjamin Graham reminds us, the intelligent investor is a realist who sells to optimists and buys from pessimists. So next time the market plunges and terror is rife, don't panic. Look deeper. Think long-term. Hold steadfast. because the ups and downs of the market are not your enemy. They're your biggest opportunity. Segment 11. The margin of safety, your ultimate protection. If you want to build a fortress around your assets, one that defends your money against blunders, market crashes, and uncertainty, you need to comprehend the most renowned notion Benjamin Graham ever wrote about, the margin of safety. This is the basic idea that divides speculators from intelligent investors. It's simple, yet powerful. It's what makes investing less like gambling and more like a reasoned business choice. So what precisely is this margin of safety? And why does Graham suggest it's your ultimate protection? Let's delve in. What is the margin of safety? The margin of safety is the difference between a stock's intrinsic value and its current market price. Think of it as a cushion, a buffer zone between what you think the business is really worth and what you really pay. If intrinsic value is $100 per share and you buy it at $70, your margin of safety is $30. That $30 is your safety net. It shields you if things don't go exactly as planned, because no investment is guaranteed. No analysis is flawless, and the future is always unknown. Why margin of safety matters. Benjamin Graham writes, "The essence of investment management is the management of risks, not the management of returns. The margin of safety is risk management in action. It means buying stocks when they are priced low enough compared to their real worth. Protecting yourself from unforeseen difficulties like economic downturns, bad management, or market panic. Avoiding irreversible loss of capital by not overpaying. This notion converts investing from a game of chance into a disciplined procedure. Real-life example, buying on sale. Imagine you want to buy a house. If the house is worth $300,000, but you buy it for $250,000, you have a $50,000 margin of safety. If the market dips or the house needs repairs, you still have a cushion before you lose money. If you buy it for $300,000 or more, any problem could mean you owe more than the house is worth. Investing works the same way. The margin of safety provides you room to be wrong and yet win. Margin of safety in practice. How do you find this margin? It starts with estimating intrinsic value carefully, like we mentioned in the prior segment. Then, you wait for a market price that's enough below that value. Graham doesn't specify a specific number, although many investors seek for at least a 20 or 30% markdown. If you buy stocks only when they have this kind of margin, you drastically limit the danger of irreversible loss. Margin of safety is your emotional shield. Another benefit, it helps you stay relaxed. When you buy with a high margin of safety, everyday price swings don't terrify you. You know you paid less than what it's worth. So when Mr. Market has a tantrum, you don't panic. You can even buy extra when prices decline. Margin of safety is not a guarantee, it's a principle. It's crucial to understand. The margin of safety is not a crystal ball. It doesn't ensure success, but it tilts the odds in your favor. It's your guardrail on the path to investment. How margin of safety fits into the bigger picture. Benjamin Graham's entire concept is centered around this idea: long-term thinking, focusing on intrinsic value, comprehending risk. All these are part of generating a margin of safety. Without it, investing becomes a gamble. With it, investment becomes a sensible, disciplined pursuit of riches. Final thought for this segment. Let's close with one of Graham's most famous quotes. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. The margin of safety is your instrument for satisfactory results, safeguarding your capital so you can expand it consistently over time. So, as you invest, ask yourself, am I paying less than this firm is truly worth? Is there enough cushion if things go wrong? Am I being patient and disciplined, or following hype? When you answer yes to these, you're investing like Benjamin Graham taught us. You're building wealth, not gambling with it. Segment 12. Defensive versus enterprising investors. Which type are you? Benjamin Graham realized that not all investors are the same. People have diverse goals, time, knowledge, and risk tolerance. So he split investors into two basic categories: the defensive investor and the enterprising investor. Understanding which type you are can save you a lot of misery and help you design a plan that matches your life. Let's discuss what each means and why Graham's counsel for both is still great today. Who is the defensive investor? The defensive investor is the quintessential set-it-and-forget-it type. This is the individual who wants to avoid big mistakes, to keep things simple, a reasonably safe investment, minimal time and effort. Graham believes this investor prefers safety over excitement. They're not chasing the hottest stock or trying to beat the market. Instead, they want stable, reliable profits with minimum stress. Defensive investors' strategy. What does this look like in practice? Graham suggests a balanced portfolio with around 50% in high-grade bonds and 50% in stocks of large, financially robust corporations. Regularly rebalanced to maintain this ratio, avoiding speculative stocks and market timing, focusing on firms with a history of dividends and steady earnings. This method may not make you rich quickly, but it's meant to protect your capital and build it consistently. Who is the enterprising investor? The enterprising investor is different. They have more time to devote to research, a willingness to take up more risk for higher returns, a passion for evaluating companies and marketplaces, the discipline to buy inexpensive stocks and sell when suitable. This investor wants to beat the market, but do so smartly. They appreciate the process of locating bargains and are eager to work for their returns. Enterprising investor's strategy. For the entrepreneurial investor, Graham recommends searching for inexpensive stocks that the market has missed, investing in unusual situations like mergers or reorganizations, buying small, financially healthy enterprises with growth potential, being cautious but adaptable to take advantage of market inefficiencies. It demands talent, dedication, and a strong stomach during tumultuous times. How to choose which investor you are. Here's the truth. Neither method is better. They're just different paths. Ask yourself, how much time can I realistically spend on managing my investments? How much danger can I emotionally handle? Am I interested in learning about businesses and markets deeply? Do I want to be hands-on or prefer a set-and-forget approach? If you prefer simplicity and safety, defensive is for you. If you love research, have time, and desire potentially larger rewards, enterprising might fit. You can mix both. But know your limits. Many investors blend features of both. Maybe you keep most of your portfolio defensive, bonds and solid stocks, and then commit a lesser part to innovative techniques, carefully chosen bargains or exceptional scenarios. Just be honest with yourself. Don't take on adventurous risks if you can't maintain calm amid downturns. Graham's final advice to both investors. For the defensive investor, Graham says, stick to quality, avoid speculation, and be patient. For the enterprising investor, he says, do your homework thoroughly, buy with a margin of safety, and control your emotions. Both demand discipline. Both require a plan. And both can succeed if you follow these timeless ideas. Final thought for this segment. Investing is a lifetime journey. Benjamin Graham's knowledge helps us understand ourselves as investors, not simply the market. Knowing your style, setting reasonable expectations, and sticking to established tactics, that's the actual road to earning enduring wealth. So take a moment. Decide who you are as an investment, because once you do, you can move forward confidently, with a plan that fits your life and aspirations. Segment 13. Investing as a business owner, not just a stock buyer. Let's take a moment to step back and ask something so simple it's often forgotten. What are you actually buying when you invest in a stock? A lot of individuals will say, I'm buying a stock because it's going up. Others could respond, it looks like a winner right now. And some are merely replicating what they see on Reddit, the news, or TikTok. But Benjamin Graham wants to jolt us a little and scream, stop, think. You're not just buying a piece of paper, you're not just tapping a phone screen, you're not playing a game. You're buying partial ownership in a real business. A business having employees, with a product or service, with customers, factories, debt, machinery, maybe real estate, with CEOs and competition and innovation and risk. And Graham adds, that perspective can change everything. The business owner approach. When Graham talks about the intelligent investor, he means someone who operates like a business owner, not a gambler, not a trader, nor a dreamer hoping for quick money. Think of it like this. If someone gave you 5% ownership in a neighborhood coffee business, would you say yes without looking at the financials? Wouldn't you like to know, how profitable is the store? How much debt does it have? How stable is the consumer base and what's the competition like? Of course you would, because as an owner, you worry about the real picture, not just hype. But now, here's the tragedy. When the same person buys a share of Starbucks or Amazon or any new tech firm, they generally don't ask any of those questions. They basically glance at the stock ticker, red or green, and make emotional decisions. Benjamin Graham says this is risky, because if you stop thinking like an owner, you start behaving like a speculator, chasing market swings instead of long-term value. Prices can lie, but value doesn't. Here's something powerful Graham teaches. In the short term, the market is a voting machine, but in the long term, it's a weighing machine. What does that mean? In the near run, people are basically voting with emotions, views, predictions, hype, and terror. That's why prices swing up and down so rapidly every day. But in the long term, Graham says, truth comes out. The real value of a firm starts to show. Earnings, cash flow, management quality, competitive edge, these are what the market eventually weighs. If you think like a business owner, that's what you focus on. Not the noise, not the headlines. You don't panic because your stock plummeted 10% this week. Just like you wouldn't sell your bakery because fewer people arrived on a gloomy Tuesday. Real-life comparison, the bakery example. Let's imagine you invest $10,000 as a part owner in a small bakery in your town. One morning, someone approaches along and says, "Hey, I'll buy your share for $8,000. Would you sell because of that strange offer? Probably not. You'd ask, is the bakery still making money? Are customers still coming? Is the management doing a good job? If everything's okay, you'd hold on, maybe even buy more. Now apply that to the stock market. What if you hold shares in a strong company like Procter & Gamble, but the stock drops 12% due of some panic? Would you sell only because the market offered to buy at a lesser price? If you're thinking like a business owner, you wouldn't flinch. You would analyze the business, not the price chart. That's exactly what Graham teaches. He's not only directing you financially, he's training your thinking. Build ownership mentality, not trader addiction. Benjamin Graham thinks one of the worst misconceptions investors make is thinking they're players in the market. That's how people get addicted to charts, apps, and checking prices 20 times a day. But here's the truth. Real wealth is built by owners, not dealers. History confirms this time and again. People who held outstanding firms for 10, 20, or 30 years and disregarded the noise typically ended up considerably richer than fast-talking traders who made 500 selections per year. The stock market will always entice you to do something now. But Graham wants you to create a quiet confidence, to believe your approach, trust your analysis, and think long-term. Warren Buffett's example. Let's bring this lesson to life with Warren Buffett, Benjamin Graham's most renowned student. Buffett doesn't buy stocks, at least not in his mind. He buys enterprises and retains them for decades. He doesn't care what the price does tomorrow, or what the news says tonight. When he invested in Coca-Cola, he wasn't gambling. He analyzed the brand, the pricing power, the client base, and the company's ability to grow for the next 20 years, not 20 minutes. And it is what Graham wants every investor to learn: to quit being a gambler and start becoming an owner. Final takeaway for segment 13. So what's the fundamental message here? Invest like you're becoming part owner of a business. That means do your research. Understand how the business produces money. Look at true worth, not just the stock price. Stay cool when others panic. Play the long game. It doesn't matter if you're investing 100 OR, 100 or 100,000. When you transform your attitude from price watcher to actual owner, you've officially taken one of the biggest steps toward becoming an intelligent investor. Segment 14. Learn from market history, don't repeat it. There's a saying that goes, "Those who cannot remember the past are condemned to repeat it." And Benjamin Graham believed this thoroughly when it comes to investment. In The Intelligent Investor, Graham tells us, the market might alter on the surface. New apps, new trends, new technologies, but the patterns remain the same. Why? Because even if the world changes, human nature doesn't. Greed, fear, overconfidence, herd mentality, these emotions motivated people in 1929, and they're still driving people today. That's why ignorance of market history is one of the fastest ways to lose money, because you may walk right into danger, thinking you're stepping into opportunity. Lesson from the 1929 crash. Let's go back to the late 1920s when stocks were booming. People assumed we had entered a new era of wealth. Everyone was growing rich, fast. You have taxi drivers giving stock tips, housewives buying stocks on margin, newspapers hype everyday price changes like a sporting game. But what happened? The Great Crash of 1929. The market lost approximately 90% of its value by the early 1930s. Millions of people were wiped out because they'd confused speculation with investing. They overlooked risk. They believed the hype. And Benjamin Graham observed this firsthand. He was a successful investor until he wasn't. Like everyone else, he got swept up. But instead of giving up, he analyzed the calamity, reflected, and reorganized his entire concept. And that wisdom became the intelligent investor. What does he want you to learn? Simple. Don't only examine prices. Analyze how people behaved. Because if you understand emotional cycles, you acquire power over your own reactions. History doesn't repeat, but it rhymes. Mark Twain once said, "History doesn't repeat itself, but it often rhymes." And that's especially true in the stock market. Let's look at just a few instances after Graham's time where investors could have learned from the past, but didn't. Dot-com bubble, late 1990s. The internet boom. Startups were valued at millions, even without profitability. Sound familiar? People believed, again, we were in a new economy. When the bubble broke in 2000, trillions were lost. 2008 financial crisis. People were buying homes they couldn't afford. Banks were lending money to everyone and packaged debt like candy. Once again, overconfidence, avarice, and a false sense of security brought economic calamity. Crypto and meme mania 2020 into 2022. People were putting life savings into Dogecoin, NFTs, and meme stocks with zero understanding. Some made quick profits, most lost large amounts. Why? The same human emotions at work. Graham's message would have been clear. Every boom has a crash, when speculation outweighs reason. Why people keep forgetting. Here's the funny thing. Even with so much history to learn from, people still fall into the same traps. Why? Because we focus too much on the present. We convince ourselves that this time is different. We say, AI is going to change the world. Crypto is the future of money. Tech stocks can only go up. And maybe those things are true in part, but Graham warns us, never let belief override prudence. Even brilliant technologies can become deadly when investors attach unreasonable expectations to them. Lesson: just because the car is new doesn't imply the mistakes aren't old. Using market history as your protective shield. So what do we do with this history? Benjamin Graham says, use it as your shield. Before you invest in anything, ask, has something like this happened before? What went wrong the last time people acted like this? Am I following logic or emotion? For example, today, people might rush to invest in hot sectors like artificial intelligence, green energy, or new tech IPOs. Graham wouldn't say don't invest. He would say invest with clarity and caution. Look past the hype. Study the business model. Study the price relative to value. And most all, remember that the crowd is virtually always wrong in extremes. Emotional memory is stronger than market data. Reading graphs is beneficial. Studying charts is useful. But Graham encourages something more potent: emotional memory. Try this exercise. Look back to a moment when the market crashed, like 2008 or 2020 during COVID. Now ask yourself, what were people saying back then? How did they feel? What decisions were made out of fear? And who ended up benefiting? After clarity returned. If you can lock in those emotional memories, whether you experience them or not, you construct psychological armor. The next time panic hits or the next bubble forms, you won't be easily shaken. You'll stand on solid footing while others respond emotionally. That's what Graham means by being prepared. Becoming a student of the market's past. Graham isn't asking you to be a historian, he's asking you to be a student of patterns. Just by reading a few market case studies or viewing documentaries on prior crashes, you start to see the same warning signs. Prices rising too fast. Media acting like cheerleaders. New investors entering simply for rapid money. People saying, "This can't go down." And every time those symptoms appear, it's like storm clouds before a hurricane. Benjamin Graham's insight lets you recognize the clouds and prepare before the rain hits. Final takeaway for segment 14. So here's the ageless truth. Markets fluctuate, people don't. The tech might be different. The emotions are always the same. If you forget financial history, it will come back to teach you the hard way. Benjamin Graham doesn't just provide you an investment approach. He provides you a prism through which you may look beyond the now, into patterns, into psychology, into long-term knowledge. Lesson: study the past, respect it, and utilize it to defend your future. That's how you evolve into an informed investor, not just brilliant with numbers, but wise with experience. Segment 15. Adapting Benjamin Graham's wisdom to the modern world. Now let's be honest. When you hear that The Intelligent Investor was initially published in 1949, your first instinct might be, wait, isn't this outdated? I mean, Graham didn't have crypto, he didn't live through the internet. He didn't use trading applications or AI or Instagram financial influencers. How can his lessons still apply? And it's a valid question. The financial world today is faster, noisier, and more complex than ever before. You can buy or sell a stock in seconds. Information moves at the pace of a tweet. The entire market can shift in one day because of a headline or a celebrity post. But here's what Benjamin Graham would say. The tools may change, the packaging may evolve, but the principles of wise investing, discipline, patience, reasonable thinking, and value do not age. In fact, in today's hyper-reactive financial market, his knowledge is not just relevant, it's necessary. Principles over predictions, then and now. The heart of Graham's message isn't a step-by-step procedure, it's a mindset. And that approach, of long-term thinking, emotional control, and focusing on a business's genuine worth, has never been more potent. Think about this. In Graham's time, people read newspapers. Today, consumers surf through TikTok, YouTube, Reddit, and Twitter for investment advice. But human psychology? Still the same. FOMO still exists. Panic selling is still real, hot tips are still deadly, and people still chase what goes up and flee when things go wrong. Sound familiar? Graham warned of all of this, long before we had smartphones or online brokers. His advice wasn't built for Wall Street, it was developed for the individual who wishes to win the inner game of investing. Modern investing equals more access equals more temptation. Yes, contemporary tools have made investing easier. You can open a trading account in 5 minutes. You can invest in equities, coins, NFTs, anything, with a tap. But ease brings temptation. Today, millions of people are investing not because they've done research, but because an influencer pushed something a friend stated, this coin is going to the moon, or someone showed off their earnings. Graham would look at this and say, this is not investing, it's emotional gambling, with the illusion of intelligence. He tells us, just because something is hot doesn't make it valuable, and just because you can act rapidly doesn't mean you should. Technology provides us speed, but Graham provides us wisdom. Timeless tools for a modern portfolio. Let's take some of Graham's old notions and explain how they operate in today's reality. Margin of safety, still powerful. Whether you're buying Tesla stock or investing in crypto, ask, am I leaving enough room for error? Understanding the business. Today, this includes reading 10K reports, financial summaries, or analyst insights. If you don't grasp the income model of an NFT project or startup, don't throw your money at it. Ignore the crowd. In an age of viral trends, the savvy investor learns to go against the majority when it turns crazy, much like in Graham's time. Focus on fundamentals. Even with AI and data tools, human judgment still matters. Graham's method reminds us numbers tell a tale, and our job is to grasp the plot. Graham inspired modern examples. Let's look at how some of Graham's ideas are actually being implemented now by some of the finest minds in finance. Warren Buffett still studies company reports and buys businesses he understands, much like Graham taught him. No fanfare, no FOMO, just sheer discipline. Index fund investors, following Graham's recommendations regarding defensive investment. They don't pick particular stocks. They just regularly invest in the overall market, employing dollar-cost averaging. Long-term crypto investors, even in a dangerous new industry, the clever ones use Graham's filters, knowing the product, seeking for utility, checking risk, and dismissing speculation. So even in the most current battlefields, Graham's logic forms the cornerstone of actual intellect. The battle isn't against tech, it's against yourself. At the end of the day, Graham wasn't warning us about the market or about new innovation or about applications. He was warning us about ourselves. The reason we lose money is frequently not a bad stock or a lousy tip. It's because we bought emotionally. We panicked during a dip. We didn't do our homework, or we chased trends and fell into groupthink. Benjamin Graham's fundamental message is this: the investor's worst enemy is likely to be himself. And in today's fast-paced, emotionally charged digital environment, that couldn't be more accurate. Final takeaway for segment 15. So, is the intelligent investor still relevant today? Yes, more than ever. Because in this current marketplace, when noise is loud and risk is everywhere, you need a quiet, calm voice that says, think for yourself. Study before you invest. Trust value, not hype. Be patient, be curious, be rational. And above all, safeguard your peace of mind, not just your portfolio. You can trade faster today than Graham could have imagined. But investing wisely? That still takes patience, reflection, discipline, and the willingness to not follow the crowd. And that's the real message of the intelligent investor. It's not outdated advice from the past. It's a timeless guide for your financial future. written by one of the few people wise enough to understand human behavior and money. The market will always rise and fall. Trends will come and go. But true intelligence in investing isn't about following what's popular. It's about thinking clearly, behaving sensibly, and staying true to timeless ideas. Benjamin Graham provided us more than a method. He gave us an attitude, a method to defend our money, our peace, and our future. So disregard the noise, stay patient, build gently, and remember, you don't need to foresee the market. You just need to be prepared for it. Be disciplined, be curious, be bold. And like Graham says, in the end, the savvy investor is not the one who gets rich the fastest, but the one who stays rich the longest.